Hey everyone, welcome back to Corporate Decoder. Today, Fusemachines Inc. just filed an 8K reporting a material definitive agreement, and I am seeing a huge red flag related to their share price. Quick note, this is not financial advice, just my take on public filings for educational purposes. Fusemachines has just inked a big deal that could bring in up to $20 million, but the way it is structured is really raising some eyebrows. This filing is about Fusemachines Inc., a company that develops and deploys advanced artificial intelligence and machine learning solutions. They recently became a publicly traded company, and this filing is crucial for understanding their recent financial activities. The main event here is an agreement called a controlled equity facility. Basically, Fusemachines has the right to sell its stock to a buyer, Roth Principal Investments LLC. This is a way for the company to raise capital up to a whopping $20 million. It is not a simple sale though, it's tied to how the stock is trading. This deal was made on the 17th of April 2026. Now, the company can choose to sell shares to Roth Principal Investments at various times over the next 3 years. The important thing is that Fusemachines has complete control over when and how much they sell, meaning they are not obligated to sell any shares at all. The total potential amount they can raise is $20 million. This is a significant sum for a company looking to grow. This phrase is repeated a lot and it's key. Fusemachines can decide to sell shares, but they don't have to. This gives them flexibility, especially if market conditions change. As part of the deal, Fusemachines has agreed to register over 11 million shares for Roth Principal Investments to potentially buy. This is a large number of shares that could be issued if the company decides to move forward with sales. Here's where things get interesting and look like a potential red flag. One of the conditions for Fusemachines to sell shares is that the stock price must be at least $0.5 on the day before the sale. This is a very low price threshold, indicating that the company might be preparing to sell shares even if the stock is trading at very depressed levels. The price at which Roth Principal Investments buys the shares is determined by the stock's trading price during a specific period on the day of the sale. It is called the volume weighted average price, or VWAP, with a discount. There is a discount applied to this VWAP. For most of the sales, like the market open purchases and intraday purchases, the discount is 3%. This means Roth Principal Investments will be buying the stock at a price that is a bit below the average trading price for that day. In addition to the main purchases, there are also pre-market and post-market purchase options with limits of up to 1 million shares each. These are smaller, more targeted purchase windows. For pre-market and post-market purchases, the discount is even higher. At 5%, this suggests that Roth Principal Investments is being compensated more significantly for taking on these shares during less active trading periods. To raise a limit on the total number of shares that can be issued to Roth Principal Investments, it is capped at 575,000 shares. This is a crucial number because it represents about 20% of their outstanding shares before this agreement. This suggests Nasdaq regulations might be in play, as companies often need shareholder approval to issue more than 20% of their stock. This is another big one. The 20% limit can be bypassed if the average price paid for the shares reaches $1.76. This $1.76 price is based on their stock price right before the agreement was signed. This means if the stock price recovers significantly, they might be able to issue more shares than initially anticipated. It's a mechanism to allow for more dilution if the company performs well. There is also a beneficial ownership limit. Roth Principal Investments cannot end up owning more than 4.99% of the company's total outstanding shares at any given time. This is a common provision to prevent a single investor from gaining too much control without a separate, more extensive acquisition process. The money raised from selling these shares is earmarked for working capital and general corporate users. This is pretty standard for companies raising funds, but it's important to note that it doesn't specify any particular growth initiative or R&D. The agreement includes restrictions on what the company can do with other financing. They are generally prohibited from entering into variable rate transactions. This means they can't easily set up other deals where the price can change based on the stock's performance, which could further dilute shareholders. It is a way to keep the terms of this $20 million deal relatively stable. This is a really important clause. Roth Principal Investments is agreeing not to engage in short selling of Fusemachines stock during the term of the agreement. Short selling is when an investor bets that a stock price will go down. By agreeing not to short sell, they are essentially signaling some level of confidence, or at least a commitment to not actively betting against the stock while this agreement is in place. It is a commitment to not profit from a declining stock price during this period. The agreement has a built-in expiration date, which is typically 3 years after it starts. This gives Fusemachines a window to use this facility. Fusemachines can also decide to end the agreement early if they choose without any penalty. This reinforces their control over the process. It is worth noting that Roth Principal Investments is connected to Roth Capital Partners, a registered broker-dealer. This means that when Roth Principal Investments resells the shares they buy from Fusemachines, their affiliate Roth Capital Partners will be involved in those sales. Because of this relationship, the offering needs to follow specific FINRA rules, such as Rule 5121. This rule requires a qualified independent underwriter to be involved. In this case, Digital Offering LLC has been engaged to act as that independent underwriter, ensuring the process is fair and properly vetted. Fusemachines has already paid a $20,000 structuring fee and will pay a $300,000 commitment fee to Roth Principal Investments. These are upfront costs for setting up this financing facility. Additionally, Fusemachines is covering Roth Principal Investments' legal fees. They've already paid $60,000 for initial legal work and will pay up to $7,500 each quarter for ongoing legal expenses related to this deal. As is standard with these types of agreements, there are also typical promises and protections for both Fusemachines and Roth Principal Investments, covering things like financial accuracy and legal compliance. The real kicker here, and the reason this feels like a red flag, is that Fusemachines doesn't know the exact price they'll get for their shares. It is all based on trading prices on the day of the sales, with discounts applied. This means the amount of money they actually raise could be less than the full $20 million, and the number of shares they have to issue could be higher. Especially if the stock price is low. This is what we call a dilutive offering structure, and it is often used by companies in financial distress or those facing significant stock price challenges. This exhibit holds the full details of the stock purchase agreement. It is the document that outlines all the terms and conditions we've discussed. This second exhibit details the registration rights. Basically, it ensures that the shares bought by Roth Principal Investments can be legally resold to the public. The filing is signed by Seymour Marsky, the Chief Executive Officer of Fusemachines Inc., confirming the company's official endorsement of these agreements. So, what is my take on all of this? This controlled equity facility with Roth Principal Investments, while providing a potential lifeline for capital, raises serious concerns. The low share price threshold of $0.5 and the discounts applied to the VWAP strongly suggest that Fusemachines is anticipating, or perhaps even needing, to sell its stock at very low valuations. This structure is a classic sign of a company that might be struggling to maintain its stock price or facing pressure to raise funds quickly. The fact that they are agreeing to sell shares at a discount, potentially even below $1, points to a difficult financial situation or an expectation of further stock price declines. While the $20 million potential capital infusion is substantial, it could come at a high cost in terms of shareholder dilution, especially if the stock price doesn't recover soon. The provision to bypass the 20% issuance limit if the stock hits $1.76 offers a glimmer of hope for a recovery, but the immediate terms of the agreement suggest a challenging path ahead. The risk I am watching is the potential for massive dilution if the stock price remains subdued, significantly decreasing the value of existing shares. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.